Okay, so let's start. We want to start this new topic. So let me introduce it. Our topic is called financial instruments. Now, as a company, there are various ways in which you as a company, you can borrow finances. As a company, there are various ways. One way is that you can issue shares. As a company, you can borrow by issuing shares. Number two, you can also borrow by issuing debentures. As a company, you can also borrow by issuing maybe bonds. Let us assume something like a 10% bond. So these are various ways in which you as a company, you can borrow finances. So let's assume that you are a company A looking for finances. You can either borrow by issuing shares, or by issuing debentures, or by issuing bonds. Now listen, somebody somewhere, let's call him that person B, will have to provide you with the capital or the finances that you needed. That person, it could be a person B or a company B, would either buy your shares, or could buy your debentures, or could buy your bonds. From the language of financial instrument, that person B or entity B, we normally refer to them as the investors or the lenders. You, company A, who is borrowing these finances, we refer to you as the borrower. So in a financial instrument, there will be a borrower and there will be the lenders. Now listen, B, I'm talking of B now. Whether B buys your shares, or he buys your debenture, or he buys your bonds, to him or in the books of B, there will be an asset. Because B is investing. So in the books of B, they would recognize what we call a financial asset. They would create an asset in the name of investment. You A who is borrowing. Listen, if you borrow by issuing shares, then in your books, you A, it will create what we call equity capital. And if you borrow by issuing either bonds or debentures, either of the two, in your books, you A Limited, it will create what we call a financial liability, because you have an obligation to pay that amount. Whatever the amount of the debentures, whatever the amount of the bond, as a company A, you have an obligation to pay. Now, so when you are told to define what's a financial instrument, we normally define a financial instrument as a contract. We normally define it as a contract that leads to a financial asset to one party and a financial liability or equity capital to another party. That a financial instrument is a contract that leads to a financial asset to one party and a financial liability or equity capital to another party. Of course, we have said to the investors, a financial instrument will create what? It will create a financial asset. In other words, if you, company A, you issued shares and B bought 10,000 shares of A, in the books of B, they will obviously have an account called investment in shares of A Limited. So in the books of B, they would have an investment as an asset. That is what we are saying. It will create a financial asset. Whatever the amount he paid, of course, it's an asset. He will debit the investment and credit cash. Let us assume he bought 10,000 shares at a market price of 50. That will come to 50,000. Or is it 500? 500,000. That's what we are saying. So a financial instrument, in the books of the investors, we have said it creates a financial asset. While in the books of the borrower, a financial instrument will create either, listen, it will create either a financial liability or it will create a an equity capital. That a financial instrument in the books of the borrower will create either financial liability or an equity capital. Good. So before we proceed, listen, some of you are new to the class. I've told these others before. Some of you are new. If you have not subscribed to my YouTube channel, please subscribe. If you have not subscribed the YouTube channel, please subscribe by hitting that subscription button below there so that you can be notified whenever we are posting new videos into the YouTube. If you are new to the class and you have not subscribed, please hit that subscription button. You can even hit it as you are watching this video. Hit that subscription button so that you can be notified whenever we are posting new videos into YouTube. You can even hit the notification bell so that you are notified whenever we post new videos into YouTube. Okay, so we can now continue. So for the new guys, please subscribe. Now, let me continue now. So we want to write something. Before I go into the details now, let's put down something on what we have already said. So put down the topic, financial instruments. Put down the topic, financial instruments. Put down the topic, financial instruments. Financial instruments. Financial instruments. Can you see this? Down this. A financial instrument is a contract. A financial instrument is a contract. Financial instrument is a contract that leads to a financial asset to one party. Financial instrument is a contract that leads to a financial asset to one party, and a financial liability or equity capital to another party, and a financial liability or equity capital to another party. Another paragraph. To the investors or borrowers, to the investors or lenders, a financial instrument would create. The investors or lenders, financial instrument would create a financial asset. See, to the investors or lenders, a financial instrument would create a financial asset. The paragraph. To the borrowers, a financial asset, a financial instrument. The borrowers, financial instrument. To the borrowers, a financial instrument would create. Either a financial liability or equity capital. Yet either a financial liability or equity capital. Good. Fine. So let me proceed from there now. So allow me to proceed. Allow me to proceed from there now. Now, we now know what's a financial instrument. Now listen, what we want to talk about now is how do you as an investor or you as a borrower, how do you recognize a financial instrument in your books? You have gone into a contract today that you are issuing bonds or you're issuing debentures. You as a borrower, you are issuing them to the investor. It will create an asset and it will create to you a liability. How do you recognize that liability or how do you recognize that asset on the day you signed the contract? That's what we want to talk about now. Okay? So what we want to talk about now is what we call recognition. Don't write, let me first discuss it. Recognition and measurement. Recognition and measurement of financial instruments. Recognition and measurement of financial instruments. Now listen. All financial instruments, whether it's a financial liability or it's a financial asset, all of them should initially be recognized at their fair values. When we signed that contract initially, both the parties should recognize that financial instrument at its fair value. Fair value means market value. For example, if B bought 10,000 shares of A at a time when the market price was 50, then we have seen that B had to spend 500,000 shillings to buy those shares. So in the books of B, we have seen he will open an account called investment in shares of A and he will recognize them at the market value. 50 per share on the 10,000 shares, that comes to 500. That's how B will recognize that investment at its fair value, or in other words, at its market value. Now, that's what both of the parties will do. So whether it's a financial liability or it's a financial asset, at the initial recognition, all financial instruments, listen, should be classified or should be recognized at their fair values. Good. Now the question is, what about in the subsequent periods? At the end of the year, you B, at what value will you carry down this investment? Yes, you bought it at 500,000, but at what value will you come and say your balance carry down in your investment account? At what value? That is what I want to talk about now. Listen. So in the subsequent period, after initial recognition, in the subsequent period, after initial recognition, how you as borrowers or investors, you are going to recognize that financial instrument. Listen now, it depends. How you will recognize the financial instrument will depend on whether you are dealing with a financial asset or whether you are dealing with a financial liability. Are you dealing with a financial asset or are you dealing with financial liability? That's what you will need to know first. How you will subsequently measure it, ask yourself, is it a financial asset or is it a financial liability? Now, if it's a financial asset like the one B has created in books, listen, there are three ways in which a financial asset can be remeasured. There are three ways in which a financial asset can be remeasured. Remember, in the books of B, it is them who has a financial asset called investment in shares of what? A. In the books of A, they don't have a financial asset, either financial liability or equity capital. But in the books of B, that's where the financial asset arises. So B will recognize that financial asset in any one of the following three ways. One, it can be recognized at what we shall be calling at amortized cost. A financial asset can be recognized at what we shall be calling at amortized cost. We shall talk about that later. Another way in which a financial asset can be recognized is what we call at fair value. At fair value through OCI. That means through other comprehensive incomes. Through what we call other comprehensive income. That's another way. The third way in which a financial asset can be recognized at the end of the year is at fair value through P&L. At fair value through P&L. That's another way. Now listen. When I say at fair value through, I mean this. If you look at the investment company B bought, they bought it initially at a market price of 500. Listen, if they are to remeasure it, that is, I'm assuming, if they are to remeasure it at fair value through OCI, then it means they have to get the market value at the end of the year. Listen, they have to get the market value of that investment at the end of the year. And whatever is the market value, let us assume that the market value by the end of the year is 600. That's what we are calling the fair value. Point is, whatever is the change in fair value, by the beginning of the year, it had a market value of 500. By the end of the year, it has now a market value of 600. Whatever is the change in fair value, now the requirement is you take it to other comprehensive income. That's why we call it fair value through other comprehensive incomes. Okay? Yes, you have done published. You know that under published accounts, once you are preparing an income statement, there is a section there you can be required to prepare called statement of other comprehensive income. So among other comprehensive incomes, there now you can see we are bringing another one. When we were doing, or when you did this topic of published accounts, or when you did it, that topic of published accounts, you remember we only mentioned 2 examples of other comprehensive incomes. We only mentioned 2. One of them, I hope you remember it. Is what we were calling any gain on revaluation of fixed assets. Remember we said gain on revaluation of fixed asset is classified as part of other comprehensive income. Now we are bringing in another one which we never discussed when we did, or when you did, published accounts. No. Now we are bringing in this extra one. That whenever you have a financial instrument which is supposed to be measured, and it's a financial asset, which was initially measured at fair value, and in the subsequent period is measured at fair value again, and the change in fair value should go through OCI, then that 100, for example, in our illustration here, that 100 should go to other comprehensive incomes. You don't take it to the P&L account. Yes, it's a gain. We had an investment worth 500 at the beginning. By the end of the year, the investment is worth 600. But the requirement now is that gain of 100, don't take it to the P&L. The requirement is take it through OCI, other comprehensive incomes. That's what I mean when we say that it should be measured at fair value through other comprehensive income. And if it is one, we shall look at it that later. If it is one that should be measured at fair value through P&L, then again, listen, by the end of the year, you as an investor again, you will value your investment at market value. You will value your investment at market value. Let us assume again it is 600. But this time, if it is one that is classified at fair value through P&L, then again, that 100 now, you as an investor, you take it through P&L. You take it through P&L. So there are those financial assets you may have Yes, they are measured at fair value at the end of the year, but there are those which the gain you take through the P&L, and there are those whose gain you take through P&L. We shall look at in details which kind of these assets are those. Otherwise, I've explained what I mean at fair value through P&L, or I've explained what it means at fair value through OCI. Good. Otherwise, let me review that before I go on. Otherwise, I've said all financial instruments should initially be recognized at their fair values. And I've said subsequent measurement will depend on the classification of the financial instrument, i.e., that means whether it's a financial asset or is a financial liability. And I've said if it's a financial asset, then it can be remeasured in any one of the following three ways. One, it can be measured at amortized cost. Two, it can be measured at fair value through OCI. Three, it can be measured at fair value through P&L. Good. So I want to discuss in details now, what are these kind of financial assets that should be measured at amortized cost? What are these kind of financial assets that should be measured at fair value through OCI and through P&L? What are the characteristics? What should be the nature of those financial assets? Okay? Allow me now to go through the details of the characteristics that makes a financial asset to be measured at amortized cost or at fair value through OCI or at fair value through P&L. Good. Let me go through those key important points. Now, listen. So we have said we are dealing with a financial asset. Don't write fast. Let me do a small table here. We are dealing with a financial asset. We have said there are three ways a financial asset can be remeasured. One is at amortized cost. Don't write fast. One way is at amortized cost. That's one way, amortized cost. Another way a financial asset can be measured, we have agreed, is at fair value through OCI. That's another way. Also said, another way a financial asset can be measured is at fair value through P&L. Good. Those are the three ways financial asset can be measured. Let me go through. Now, what kind of financial asset are these that should be measured at amortized cost? Let me go back. When I was talking about company A looking for finances, I said company A, sorry. When I was saying when company A was looking for finances, I said A could issue shares, A could issue bonds, and A could issue debentures. Listen. Let me assume that company A issued a 10% bond whose nominal value was 200 million. Whose nominal value was 200 million. That is what company A issued. Now, you company B, listen, you bought this bond. Maybe company A is a company that issued this bond through the stock market. They wanted to raise finances. So they issued bonds through the stock market. You as an investor, you went and bought their 10% bond whose nominal value is 200 million for whatever price. We shall discuss that later. Now listen. To you as an investor B, this bond is obviously going to guarantee you, listen, it is going to guarantee you a fixed return every year. You know from your finance knowledge that every year as an investor, I'll be earning from A, me B, I'll be earning interest income of 10% of 200 million, which comes to be 20 million. So I'll be earning that interest income. Yani, I'll be getting that interest income, the constant amount. Listen, then in the year the bond will mature, maybe after 10 years or 15 years or 5 years, then maybe I am assured again of getting back my principal of how much? 200 million. So when I buy the bonds, or it could even be a debenture, a 10% debenture whose nominal value is 100 million, I am assured of a fixed return as an investor every year. 2, on the date of maturity, I'll get back my principal. When you have that kind of a financial asset, listen, which you are buying, listen to this, you are buying so that you receive what we call the contractual cash flows. The contractual cash flows. You are holding this investment, you as an investor, with an aim of collecting the contractual cash flows. Which are these contractual cash flows? The interest of 20 million every year, 20 million every year for the next 5 years or 10 years and so on. 2, you are holding this bond with an aim of receiving that principal repayment maybe after 10 years. When you have that kind of an investment, you are holding it. Listen, you as an investor, you are holding it to maturity in order to collect contractual cash flows. And 2, those cash flows that you are aiming to collect, they are for payment. Listen, they are for payment of interest and principal. So when your investment has those 2 characteristics, you as an investor B, you are required to remeasure your investment at what we call the amortized cost. We shall discuss how to compute the amortized cost later, but my point is this. What are the conditions? The conditions for a financial asset to be measured at amortized cost. I have told you there are 2 conditions. 1, this is an investment which is held to maturity in order to collect what we are calling contractual cash flows. To collect what we are calling contractual what? Cash flows. That's 1. Listen, Bado. Then I've told you, those cash flows, that is the second point now. These cash flows, we are saying, cash flows are for payment of interest and principal. So if you as an investor B, you have a financial asset which meets those 2 conditions, then you are required to remeasure them at the end of the year at what we shall be calling the amortized cost. Good. So I'm through with the first category of those financial assets that should be remeasured at their amortized cost. Don't bother now how to compute the amortized cost. Just want you to know what nature of financial assets are these. Good. Number 2, which kind of financial assets are these that should be remeasured at fair value through OCI? Listen to this now. Under that category, we have 2 subcategories. We have 2 subcategories. One, we have two subcategories. One, for what we call debt instrument. What we call debt instrument, or what we call equity instrument. Equity instrument. Let me explain. Equity instrument. Listen. If you went to company A and bought their shares, then you are buying an equity instrument. If you went to company A and bought their bonds or debentures, then you are buying a debt instrument, because they have to pay you. Yeah? So you are buying a debt instrument. So under fair value through OCI, there are those two subcategories. Now listen. Again, you company B, you had company A is issuing bonds through the stock market. You decided, listen carefully now, as an investor, you will buy their 10% bond, whose nominal value is 200 million. You will buy it. So you bought it. Listen. But your aim of buying it, you B, is not to keep it until maturity, 10 years, 5 years from now. No. You are buying the bond of company A from the stock market with the aim of waiting and seeing that the market price, if the market price of the bond goes up in the market, I sell it and I get the profit. So your aim as B, investor B, is not to keep it until maturity. You are holding it, yes. It's true you are going to receive those contractual cash flows. Every year you will be receiving 20 million interest, 20 million interest, 20 million interest, 20 million interest. Listen. And if it happens that before maturity you have not sold your bond, you still get back your principal of 200 million. Then we are saying those payments that you are receiving again, or those cash flows you are receiving, again, they are for payment of interest and principal. So I'm hoping you're not confusing between the first category of amortized and this second one of fair value through OCI. Listen. If it's a debt instrument, like I'm mentioning, for it to be measured at fair value through OCI, again, there are two conditions. There are two conditions. One is that this is an investment, listen, which is held to collect. Held to collect contractual cash flows. Listen to this now. And I am adding something there. And contractual cash flows, and to sell before maturity. And to sell before maturity. And to sell before maturity. Yeah? Number two, the other condition is two, cash flows are for payment. Cash flows are for payment of interest and principal. Cash flows are for payment of interest and principal. Listen, I'm hoping you have already noticed the difference between the financial asset that should be measured at amortized and the financial asset that should be measured at fair value through OCI. The only difference is the one to be measured at fair value through OCI. You as an investor, you are not keeping it until maturity. You are buying it for speculation that you sell it before maturity. If you are buying it to keep it until maturity, then you measure it at amortized cost. If you are buying it for speculation, then you measure it at fair value through OCI. Are you there? Good. So the only difference between the two is this second condition I've added there, to sell before maturity. Sell before maturity. Good. Sawa. Next, listen to this now. What about if you bought shares of A? We are saying you are buying an equity instrument. Which kind of that instrument should I measure me B at fair value through OCI? If you are buying shares, we are saying this for equity, these are for shares that are not for trading. Shares that are not. You are buying shares, listen, but not for purpose of trading. That means not for speculation, but for long term. If you are buying shares of company A and your aim is to keep them for long term, then saying they should be measured at fair value through OCI. Here we are saying for shares that are not for trading. That means we can say here, i.e., listen, i.e. for long term, held for long term, held for long term. Good. So that kind of an asset, an asset that has that feature, it's an equity instrument. You as an investor, you are buying it, keep it for long term, then measure it at fair value, and the change in fair value, take it through OCI. Good. Next, what about the last category? At fair value through P&L. At fair value through P&L. Listen, this is again, listen, for any other financial asset. Any other financial asset which cannot be classified either at fair value through P&L, no, through OCI, or it cannot be classified under fair value through, not at amortized cost. If you have a financial asset which can't fit in the first two, that means at amortized cost or at fair value through P&L through OCI, then that kind of a financial asset, whichever it is, then automatically it must go and be remeasured fair value through P&L. So it is for those financial assets, any other financial asset. Maybe I can say, e.g., shares for trading. If you are buying shares for trading, then automatically that means this is shares for trading. Shares for trading. When you are buying shares for trading, then you cannot put them under fair value through OCI. Because I told you, for those shares through OCI, they must be ones that are kept for long term. Are you there? Good. So I'm through. Listen to this now. I am now through on how financial assets should be remeasured. Either they are remeasured at the end of the year at amortized cost. I've said I'll talk about how to compute it. or at fair value through OCI, or at fair value through P&L, at fair value through P&L. Are you there? Good. Then we have discussed what characteristics should that financial asset have in order for it to be measured at amortized cost, at fair value through P&L, or at fair value through OCI. Good. Those at fair value through OCI, say there are some two subcategories. Either it's a debt instrument or it's a equity instrument. Good. Now, I am through now. Listen, I'm through now. I've said all financial instruments initially said they should be measured at fair values. In the subsequent periods, I said how they are remeasured depends on the classification. In other words, is it a financial asset or is it a financial liability? We are through with our discussion concerning financial asset. What about financial liability? In other words, now we are looking at it. Listen, we are not looking at it now. We are not looking at it from the point of view of B, investor B. Now we want to look at it from the point of view of A, the borrower. Because it's from the borrower who they have a financial liability. How will they measure it again at the end of the year? You issued your bonds. You issued your debentures. So in your books, it created a financial liability. How will you measure that financial liability at the end? We have agreed. Initially, you measure it at its fair value. But in the subsequent period, how will you remeasure it? Listen to this again. You as an borrower, by the end of the year, you will have to measure that financial liability at its amortized cost. At its amortized cost. You will compute the amortized cost of that financial liability and you value it at its amortized cost. Listen, we shall discuss how to compute the amortized cost. Listen. Otherwise, listen, you may have issued you might have issued the 10% bond. Listen to this. Through the stock market, but your aim of issuing that bond is this. You are waiting for the price of the bond to go down so that you redeem it, you pay back. For example, you issued bonds whose nominal value is 200 million. Investors paid you 200 million through the stock market. But you realize now the market price has gone to 180 million. I can buy back that bond. That means I can redeem it. I pay 180. Remember, I got 200. I pay 180 and I've gained 20. Meaning, listen, you issued this bond, not for purpose of raising finances, but you issued it for speculation. Of course, not many companies do that. In most companies, whenever they are issuing bonds or debentures, they are normally issuing them to raise finances. But we are saying, if the aim of you issuing the bonds or the finance or the debentures, if the aim is for speculation, then they have to be measured at fair value through P&L. At fair value through P&L. Meaning, remember initially you measured them at market value. Now you measure them again at market value. And the change in the market value, take it through P&L. Otherwise, we are saying all financial liabilities should be remeasured at their amortized cost unless they are for speculation, whereby should be remeasured at fair value through P&L. Should be remeasured at fair value through P&L. Good. Otherwise, in most cases, it should be measured at their amortized cost. Good. I think now we can put down the summary of what we have said about how to recognize and measure financial instruments. So have a subheading, and call it this way. Subheading and call it this way. Recognition and measurement. Recognition and measurement. Recognition and measurement of financial instruments. Recognition and measurement of financial instruments. That is the subheading. Recognition and measurement of financial instruments. Recognition and measurement of financial instruments. Can you say this? Say this. All financial instruments, all financial instruments should initially be measured. All financial instruments should initially be measured at their fair values. All financial instruments should initially be measured at their fair values. At the fair values when the parties when the entities became party to the contract. I've said all financial instruments should be measured. All financial instruments should initially be measured at their fair values. All financial instruments should initially be measured at their fair values when the entity became party to the contract. When the entity became party to a contract. Party became party to a contract. Party became party to a contract. Another paragraph. Another paragraph. The paragraph. Subsequent measurement. Subsequent measurement after initial recognition. Subsequent measurement after initial recognition depends. Subsequent measurement after initial recognition depends on the classification. Depends on the classification of the financial instrument. Subsequent measurement after initial recognition depends on the classification of the financial instrument. i.e. whether a financial instrument is a financial asset or a financial liability. i.e. whether a financial instrument is a financial asset or financial liabilities. Or a financial liability. Another paragraph. Another paragraph. Another paragraph. Financial assets can be remeasured. Financial assets can be remeasured at any one of the following three ways. Financial assets can be remeasured at any one of the following three ways. 1. Financial assets can be remeasured at any one of the following three ways. 1. At amortized cost. 2. At fair value. At fair value through other comprehensive incomes. At fair value through other comprehensive incomes. Bracket OCI. 2. At fair value through other comprehensive incomes. Bracket OCI. Number 3. 3. At fair value through P&L. 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 Good. So with that now, I don't need to rub this table. I don't need to rub this table, so you can even copy it. Just copy it. Just copy it. We don't need to rub that chart. You can copy it as it is. You have the financial asset at the top. Then you have three branches, either at amortized cost or at fair value through OCI or at fair value through P&L. Have those three branches. Have those three branches. Have those three branches. Have those three branches. Then when you go down, now we are starting on the first branch. Now we are starting on the first branch. Now we are starting on the first branch. And the first branch is the one at fair value. No, at amortized cost, sorry. At amortized cost. At amortized cost, I've given two conditions. Can copy them. At amortized cost, I've given those two conditions. Number 1, held to maturity. 1, held to maturity in order to collect. Held to maturity in order to collect contractual cash flows. Held to maturity in order to collect contractual cash flows. 2, cash flows are for payment. Cash flows are for payment of interest and principal. Cash flows are for payment of interest and principal. Good. That's all for the first category, and that is at amortized cost. Finish. We want to go to the second category now. Finish. We want to go to the second category, and that is what we are calling at fair value through OCI. At fair value through OCI. Below that, have the two subcategories. Below that, have the two subcategories. 1, you can even say this for debt instrument. Let me put it that way. for debt instruments. Then the other table, let me call it for equity instruments. Good. So if you are through under for debt instrument, there are two conditions there. Let's start with those ones. For debt instruments, the two conditions are as andika, held to collect contractual cash flows, and that's another condition there, and to sell before maturity. Sell before maturity. You can underline the word sell before maturity. That's important to remember. Sell before maturity. Then condition number 2 under that, condition 2, andika cash flows are for payment. Cash flows are for payment of interest and principal. Cash flows are for payment of interest and principal. Cash flows are for payment of interest and principal. Cash flows are for payment of interest and principal. Okay? That's all for the second category. Finish, we go to the other subcategory of the second class. Finish, if you are still copying. We want to go for equity instruments, still under fair value through OCI. Want to mention which are these instruments that should be measured at fair value through OCI, and they are of equity in nature. That means they are shares. Finish. I hope you are through with the two conditions. Now we go back to the third column at the second sub-column. And that's what we are calling for equity instrument. For equity instruments, there you can say, under that you can say, for shares that are not for trading. 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 i.e., those held for long term. i.e., those held for long term. i.e., those held for long term. Good. Finish. We want to go to the last branch. That's what we were calling at fair value through P&L. Finish for those who are still copying. For the last category, it was that for fair value through P&L. Fair value through P&L. Then you write this. Under that unaweza kusema for any other. any other financial asset. Any other financial asset. Any other financial asset. E.g., shares for trading. E.g., shares for trading. E.g., shares for trading. E.g., shares for trading. Good. So finish. We are now through with that. We want to discuss the liabilities now. We have discussed assets. Finish. We want to put a small note for liabilities. Otherwise, for assets, we are through. Okay, so let's proceed. After you're through with the table, andika hapo chini NB. If you're through, andika tu hapo chini table. After the table NB. Below the table, unaweza andika NB. Then you can see this. Financial liabilities. Financial liabilities should be measured. Financial liabilities should be measured at their amortized cost. Financial liabilities should be measured at their amortized cost. Financial liabilities should be measured at their amortized cost, comma, unless financial liabilities are measured at their amortized cost, unless they are held for trading, unless they are held for trading, i.e. for speculation, unless they are held for trading, i.e. for speculation, whereby trading or speculation, whereby such liabilities should be remeasured, whereby such liabilities should be remeasured at their fair value, through P&L, at their fair values through P&L, where such liability should be remeasured at their fair values through P&L. Good. I think I'm through now with the summary of how to recognize. That means recognizing means those conditions. How to recognize and remeasure. Now we want to talk about how do we compute the amortized cost, blah, 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 and so on. That's what I've talked about. I've not talked about. We have just been saying, if it's a financial liability, like I'm just finishing by saying, or we have just finished by saying, all financial liabilities should be remeasured at their amortized cost. Then there are also financial assets that should be measured at their amortized cost. Those which we are saying at fair value, that's not a big deal. Just get the market value. By the end of the year, what is the market value? That is okay. That is something you can calculate, or you can get from the market. You can get the market value. But when it comes to amortized cost, it is something you have to calculate. Okay? So allow me to take you through now how to compute those values. Yeah? Now listen. Now, as a borrower, you issued, listen now, you issued a 10% bond whose nominal value was 200 million. You may not have issued this bond at par. Yes, we know the face value or the par value of this bond is 200 million. Listen. But because you wanted to receive the money very fast, so you gave an incentive to the buyers or to the investors. Told them, I'm issuing you a bond, nominal value is 200 million, but I'm issuing to you at a discount of 5 million or 10 million. Let's assume you issue to them at a 5% discount. So if you issued the bonds to the investors at a discount of 5%, 5% of 200 million is 10 million. Listen. So you, company A, who issued this bond, you did not receive 200 million because you never issued it at par. You issued it at a discount. It is obvious when you are going to redeem the bond 5 years, 10 years from now, you will still pay 200 million. But because you wanted to raise money, you gave an incentive to the investors. Told them, give me 190. But when it comes to the year of redemption, I'll pay you 200. Okay? Now listen. So this 190 becomes what we call the fair value on initial recognition. In other words, we normally determine what we call the net proceeds. How much are the net proceeds that you received from the issue of this bond? Whatever is the net proceeds, that becomes the fair value on initial recognition. Now, still this company A, listen, as much as they issued a 200 bond and they issued at a discount of 5%, which is 10 million, they ended up receiving 190. Listen to this now. But for them to raise this bond, they had to prepare as prospectors to go to the market, pay lawyers to try and prepare the memorandum or whatever, pay the accountants to prepare prospectus and so on. Listen. So they ended up incurring maybe another 5 million shillings as what we call the issue cost. The issue cost, 5 million. Listen. This is what we are calling issue costs. Not all questions have it. But then, you, company A, you received 190 from your investors, but you had to spend 5 million to raise these finances. So effectively, listen, effectively, you did not receive 190. Effectively, you received 185 million. You issued a bond whose nominal value is 200 million. You never issued it at par. You issued it at a discount to encourage guys to pay you, give you money. You gave them a discount of 5%. So you ended up receiving 190. But on top of this, you incurred some cost. Hire lawyer, accountants, blah, 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 so on. So there was some issue cost in the process of raising these finances. Let's assume 5 million. So automatically it means then you did not effectively receive 190. No. This bond, you received 185 million. Now listen. So that 185 million becomes the fair value, which we are saying it is the net proceeds. I've discussed with you now how we shall be computing the fair value on initial recognition for a financial liability. This is company A, which issued this bond. So they have a financial liability, which they are required to measure it initially at its fair value. How do you get the fair value? You get what we are calling the net proceeds. The net proceeds issue of the bond. Took the nominal value. If there was any discount that the bond was issued at, minus. Effectively, therefore, you company A, you received 190 from the investors. But you had to incur cost of borrowing, or a cost not of borrowing, of issuing these bonds. That's what we are calling issue cost, whatever. Or it could be brokerage cost, brokers fees, whatever it is. So if you ended up spending another 5 million, then we are saying effectively you did not receive 90, effectively received 185. That is the initial value, the fair value. Now listen, in the subsequent period, you as a borrower, it's a liability. Measure it now at its amortized cost. Measure it at its amortized cost. And that's what I want to talk about now. How do you calculate the amortized cost of this bond at the end of each year? It will mature in the next 5 years. But at the end of each year, you are required to measure it at its amortized cost. So it is at this point in time that you prepare what we call the amortization schedule. You will have a column for the year. You will have a column for the balance brought down. You will have a column for what we call finance cost. You will have a column of what we call cash paid. And finally, you will have a column for balance carried down. We are assuming the bond will mature after 5 years. Now listen, by the beginning of year 1, which is on initial recognition, your financial liability is 185. That was the initial value on recognition. That becomes your balance brought down, 185. Listen, this is a liability. You are borrowing. As a company A, you are borrowing. So there will obviously be a cost of borrowing, which we are calling finance cost. Now listen, we issued a 10% bond. This 10% is what in finance you normally call the coupon rate. It is not what we call the market rate or required rate of return in the market. Or in other words, what we call the effective interest rate. No. Listen, to compute the finance cost, how much it will cost you or you will charge your P&L account as your finance cost, listen, you have to use the effective interest rate of this bond. The question might tell you that the effective interest rate of this bond was maybe 12%. So you use 12% to compute the finance cost. Listen, to compute the cash paid, I told you this when I was introducing it, that you as company A, you issued a 10% bond whose nominal value is 200 million. I said every year you will be required to pay 10% of 200 million, 10% of 200 million, 10% of 200 million to the investors. So that 10% that we are talking about is the percentage which we normally call the coupon rate. Listen, and it is that coupon rate that we normally use to calculate the cash paid. So to get the cash paid, you use the coupon rate, 10%. Listen, on the nominal value or the par value, which is 200 million. So for the next 5 years, every year you will be paying 20 million, 20 million, 20 million, 20 million, 20 million. That is what we call the cash interest payments. The borrowing cost or the finance cost, so cost of borrowing, which is the finance cost, we compute it on the amount of the liability at the beginning of the year, and we use the effective interest rate. We use the effective interest rate. In that case, we began the year with a liability of 185. You will be given the effective interest rate of this bond. I have assumed 12%. 12% of 185 million is how much? 12% of 185 million is like how much? Let me calculate and see. We are just trying to estimate. 12% of 185. That's about 22.2 million. For purpose of illustration, let me assume 22 million for purpose of illustration. Now, so at the beginning, I had a liability of 185. I am being charged interest of 22, but I'm paying 20 at the end of the year for servicing interest. Listen, I am not paying the 20 for part repayment of the principal. No. The principal will be redeemed after 5 years, 10 years, whichever the question will tell you. So the principal of 200 million, which is we saw, that will be redeemed after 5 years, 10 years. So, but when I'm paying 20, 20, 20, 20, I am only servicing the interest component. I'm not paying the principal amount. Good. So what is our carry down? 185 plus 22 being the interest charge minus the 20 we are paying for that part. I can see 22 minus 20, that's a change of 2 positive. 2 positive, if I add to 187, that looks like 185, sorry, that comes to 187. That 187 becomes the balance by the beginning of second year, 187. Then again, I take 12% of 187. How much will be the interest rate for that year? Looks like 22.44 for purpose of illustration. Listen, purpose of illustration, I want to assume 23. Then you pay 20. What are we carrying down? 23 minus 20, that's an increase of 3 positive. I add to 187, that looks like 190. 190, I bring it down by the beginning of year 2, by the beginning of year 3, 190. Listen, I take 12% of it. I am assuming I get something like 24 as the interest expense, or what we are calling finance cost. Then I get the balance carried down. 24 minus 20, that's 4. 4 plus 190, that's 194. Then I bring down the balance by the beginning of year 4, 194. Again, I get 12% of that 194. Purpose of illustration, let me assume 25 for purpose of illustration. Then I take 25 minus 20, that's a positive 5. I add it to 194, that comes to 199. Then in the final year, now I come, say 199. I again take 12% of that 199. Let me assume that I get an amount of 26. Listen carefully now. We are in the final year. And in that final year, listen, you are redeeming the bond. You are redeeming the bond. Listen carefully. The question will tell you, how are you redeeming this bond? If the question tells you you are redeeming the bond at par value, then you come and pay your 200 million. That is how you are redeeming. Listen, the question could tell you you are redeeming this bond at a premium. So the nominal was 200 million, but you agreed with the investors that you will redeem the bond at a premium, let's say of 2.5%. 2.5% of 200 million is how much? I'm assuming. Question tells you that. We saw 5% of 200 million was 10 million. Good. 2.5% therefore must be 5. If I'm redeeming the bond at a premium of 2.5%, means, listen, I pay the 200, and on top of that 200, I add 2.5% of it, which is like 5 million. So in the end, I'm paying 2 or 5 million. Once I pay that, there should be no balance at all that we are carrying down. There should be no balance at all to be carried down. So this is how we prepare an amortization schedule. This is how we prepare an amortization schedule. I've told you, start with the balance that you began with as the fair value on initial recognition. I've told you to get what we are calling the finance cost, or in other words, what you could call the interest charge or the interest expense. You use the effective interest rate in the market, okay, for that bond. What is the effective interest rate? Then I've said to get the cash paid, use the coupon rate. And I have told you is the coupon rate on the nominal, not on the balance brought down, on the nominal value, because you are servicing the loan or the bond at 20% of the nominal. Every year you pay 20%, at 10% of 200, pay 20, 20, 20. Then get the carry down that way. Now listen, having prepared this schedule, now I need to know, how are you as borrower A? Remember, you're the one issuing the bond. How are this bond, or how will this bond affect, listen, how will it affect your financial statements? Your financial statements include P&L and balance sheet. Now that we have prepared the schedule, let's see how it will affect your P&L account. In that P&L account, what will appear? You will have a column for the year, and you will have a column for the interest, or what we are calling the finance cost. Every year, how much are you being charged as the finance cost? Year 1, year 2, year 3, year 4, and that is year 5. For the first table, or for the first year, got an expense of how much? In terms of interest, finance cost 22. That is what will go to the P&L account as finance cost 22. Second one, I think I assumed 23. Third one, I assumed 24. Fifth one, I assumed 25. Yes. Fifth one, I assumed 26. That's the only, listen, that's the only item that will go to the P&L account concerning this bond, concerning that bond. Good. Now listen, what about in the balance sheet? Listen, we are company A who borrowed by issuing. So we have a financial liability, which we have said should be measured at its amortized cost. We have already computed the amortized cost by preparing this amortization schedule. So by end of year 1, for example, I can see the amortized cost of the bond is 187. By end of year 2, it's 190. By end of year 3, it's 194. The amortized cost by end of year 4 is 199. And finally, in the 5th year, there will be no cost or no liability, because that year is the year you are redeeming. Good. So as far as balance sheet is concerned, listen, as far as balance sheet is concerned, there are 2 things that we shall be taking to the balance sheet. Balance sheet or statement of financial position, year 1, year 2, year 3, year 4, and year 5. Listen, among your non-current liabilities, somewhere you will have what we are calling a 10% bond. a 10% bond. Again, listen, among your current liabilities, somewhere again, you will be having a 10% bond. Now, I want you to follow my explanation of that table so that we move together. According to this amortization table, I am carrying down by end of year one, listen, I'm carrying down by end of year one a liability of 187 million. It's a liability. Will I classify it as a long-term liability or will I classify it as a current liability? Listen, I've told you this bond will be redeemed in the 5th year. That's when we shall pay the principal. I've just told you that though I am paying 20 million every year, I am not servicing the component of the principal. No. Everything of the principal will be paid in the 5th year. Now listen. So it means therefore that if by end of year one I'm carrying down a liability of 187, I will have to ask myself, how many more years are still there or are still remaining for you to pay that 187? I'm still remaining with second year. Remember, I'm doing balance sheet of year one. Still remaining with the second year, third year, fourth year, and the 5th year. I'll pay by the end of the 5th year. So I'm still remaining with 4 more years to pay that 187. And therefore, I'll take it to the balance sheet of year one, a long-term liability. That 187 becomes long-term 187. There will be nothing out of that 187 that will be considered as a current liability. No. We go back to the table again. Year 2. What are we carrying down? By end of year 2, we are carrying down 190 as our liability. You see, again I have to ask myself, how many more years are still there for us to pay that 190? I am doing the balance sheet by end of year 2, so I still have the 3rd year, 4th year, and the 5th year. So that 190 still has 3 more years to go. That's long term. So in the balance sheet of year 2, I take that 190 as long term. Good. Take that 190 as a long term liability, meaning, again, nothing of it will be current. No. We go to 3rd year now. Go to 3rd year. In the 3rd year, we are carrying down liability of how much? 194. 194. Again, this amount will be paid at the date of redemption, which is in the 5th year. Because I'm paying 20, but that 20 I've told you, it's not part of the principal. It's all purely interest. So this 194 is part of the principal. So, in that case, end of year 3, I'll ask myself, how many more years do I still have to pay this 194? I now still remain with the 4th year and the 5th year. 2 more years to pay that 194. So in the balance sheet of year 3, that 194, I take it the balance sheet long term again. In the balance sheet of year 3, that is 194 long term. Nothing current. Nothing current. Now watch year 4. Now watch year 4. By end of year 4, we are carrying down a liability of 199. We are carrying down a liability of 199, which will be redeemed in the 5th year. I am at the end of year 4. So I will ask myself, how many more years do I still have for me to pay this 199? I am at the end of year 4, and I know the following year, 5th year, by end of next year, I should have paid that 199. So it means that 199 still has only 1 more year to go. As at the end of year 4, I still have only 1 more year to go. Therefore, I will classify that 199 now not as long term. I will classify it as a current liability. Classify it as a current liability, meaning in the balance sheet of year 4, there will be no long term. Are you following? Hope so. By end of year 4, I am carrying down 199, which must be paid within the next 1 year. Remember, in the 5th year, there is no liability to be carried forward. So that 199 automatically become current component. Good. In the 5th year, from our table, you remember there was a dash. There was nothing to carry down. So in the 5th year, there will be no long-term liability. There will be no current liability. There will be no long-term, no current. Are you following now? This is how that financial instrument will affect the balance sheet. Okay? So in the balance sheet, you needed to know those balances you are carrying down. Will you classify them as long-term liability? You classify them as current liability. Okay? Because some of them will take you more than a year to pay, because you will redeem everything in the year of redemption. Whether the question is for 10 years, you know that any liability by the end of year 1, I still have another 9 more years to go. That's long term. You go on that way, that way, that way. The only issue is the second last one. It will mean you have only 1 more year to go. And in that 1 year, have 1 more year to go, that becomes a current liability. That becomes a current liability. I hope you are following. Good. So we are through now on how compute, listen, on how to compute the fair value on initial recognition. I told you to get the fair value of this bond on initial recognition. What did I have to do? I had to calculate the net proceeds. The net proceeds from the issue of this bond. How much am I receiving? Me as investor, no, me as borrower company A, how much am I receiving net from this bond? I issued a bond whose nominal value is 200 million. I issued it at a discount, so I never received the 10 million. So effectively, I received 190. If I never had any cost of raising the funds, that means I would have received 190. But because I had to spend another 5 million to raise these finances, either as broker's fees or issue cost, whatever it is, then it means that effectively I never received 190. Effectively, I received 185. So any issue cost, I am deducting from the process so that you get the effective amount or the net proceeds receiving. That becomes the fair value on initial recognition. So to get the fair value on initial recognition, just get the net proceeds. Once you do that, now you can compute or prepare an amortization schedule so that you get the amortized cost of the bond at the end of each year. Start with the balance by the beginning, that is the liability. Come and get the finance cost, I've told you. Get the finance cost, I've told you. Use the effective interest rate of that bond. And I've told you to get the cash paid, use the coupon rate. Use the coupon rate. And that coupon rate is computed on the nominal value of the bond. Good. And it will always be constant every year. Good. Then you get the balances carried down now. Get the balances carried down, wherever they are. Then you go on until you finish. The other thing to check from the question is how are you redeeming the bond? Could be you're told to redeem the bond at par. Could be you're told to redeem the bond at a premium. Whatever it is, find out from the question. Good. Once you redeem, there should be no balance carried down. It should be cancelling. Like for example here, let me confirm whether it could be cancelling. Let me confirm. I had 199 plus the interest of 26. If I minus 20 interest I paid, I minus 205, The principal, good, remains with a balance of 0. Good. That is what we are saying. In some questions, there may be a small difference because of percentages, no problem. Then once you prepare that, see what you will charge in your income statement. That is what? Finance cost. That is the finance cost for every year. What about in the balance sheet? Said in the balance sheet, you will have a long-term liability and a current liability. Long-term is that liability which will take you more than a year to pay. Current is that which will take you less than a year to pay. Good. We have seen the table, I was carrying down a liability of 187 by end of year 1. And because everything will be redeemed in the 5th year, I had to ask myself, how many more years do I still have to go? I am still having second year, third year, 4th year, and 5th year. 4 more years to go for me to pay 187. That's long term. Same to year 2, I still have another 3 more years to go. Same for year 4 or 3, I still have another 2 more years to go. When I was arguing about year 4, so carrying down liability of 199. But in the next year, by end of next year, I should have cleared it. So that 199 will take me less than a year to pay. And therefore it becomes current. And of course, in the final year, there will be no long term, no current. Good. So for today, maybe we can stop there, pick it up from there next time, where now we shall do an example, officially putting it down. Shall put down an official example and do a few past paper questions. Otherwise, listen now. I'm still reminding you, those who are new to this class, I've told you, please subscribe. Please subscribe to my YouTube channel if you have not subscribed yet. Click that subscription button even as you are watching this video now. And click that subscription button that will notify you whenever we post new videos into the YouTube. And even click the notification bell. Now listen also, for the sake of others, listen. You may be here and you have friends who would want to join this class or even the other classes. Let me just talk about in general. Whether you belong in this class I'm talking about or not, what do I do online? Now, for financial reporting, we have the one for advanced financial reporting. If you have friends who would want to join it, we have advanced financial reporting. When it comes to advanced financial reporting, we have either early morning classes or we have evening classes. Tell your friends if they want to join early morning classes, the classes are every Monday, Wednesday, and Saturday. Of course, from 8 p.m., 10 p.m. If they choose even that is evening. That is, I've confused the timing and the days. I was supposed to talk about the timing for early morning. Early morning is Monday, Wednesday, and Friday. Monday, Wednesday, and Friday. From 5:30 in the morning to 7 in the morning. To 7. For evening classes, it's Monday, Wednesday, and Saturday. From 8 p.m. to 10 p.m. So tell your friends if they want to join the advanced financial reporting of the advanced level. Any of your friends who want to join financial reporting of the intermediate level, tell them the classes are every Tuesday, Thursday, and Friday. From again 8 p.m., 10 p.m. Now listen. It is also possible, whether you join the advanced financial reporting or you join the financial reporting, in case you miss a class, maybe it's on a Friday Or if it's an early morning class, you wake up when it's late, class is gone. Does it mean you will miss that class? The answer is no. We are saying, in case you miss a class, don't panic. You can still watch the video of the class that you missed. Just go back to the group where the link was posted, click on the link, and you'll be able to watch the video of the class that you missed. Or alternatively, you could have been taught and you still want to listen to the video again, go to the group, click on the link of the class that you want to watch again, and you'll be able to watch. Okay? Good. Now listen again. We also have financial accounting for for CPA foundation level, for ATD1 and 2, and also for CS and CIFA for those beginners. So whether they are doing CS, CIFA, those beginners, or foundation, which used to be called section 1, and ATD1 and ATD2, we still have financial accounting online class. Okay? Now, listen. If somebody is not able to join the live class, whether advanced financial reporting or financial reporting, if you're not able to join the live class, then you can also buy what we call pre-recorded videos. You can buy what we call pre-recorded videos, where you get the videos for the whole syllabus, all of them at once, and you watch them at your own free time, at your own pace. You watch them at your own free time, own pace. Okay? Good. Now, for any of these subjects, we are currently charging 4,200 for the whole semesters, and we also accept payments on installments. We accept payments on installments. That one can be organized. If any one of your friends are interested, then they can call me on 0722 65 8875, 0722 65 8875. Then we can talk. This is how our online program is. Okay, so that is it. Charging 4,200, accept payments in installments. Any one of your friends being interested, let them call 0722 65 8875. Then we can talk. Okay, otherwise, see you next time. But please, again, as an appeal, please do subscribe to the YouTube channel by clicking that subscription button. You could also be a part of this class and you have not subscribed. Just please subscribe. Just hit that subscription button and even do it right now. See you next time. Bye for now. Continue from there next time, where now we shall do an official example for that financial instrument and then do a few past papers. See you next time. Bye for now. Bye for now. See you. Bye.